All right. Well, I'm with my friend Jack Selby. I'm very excited about this because, Jack, we could talk about 900 subjects, and I promise you, brevity is a critical component of our friendship. But I want to stay on topic on a couple things that have really been on the minds. And for those who, for the first time, might be, consuming the knowledge of Jack Selby, you have actually a pretty interesting past, present, and now future. Just for the audience sakes, just 1 minute, go through where you started, where you're at and where you're thinking about for the future. I mean, PayPal is obviously probably a pretty good place for you to start about, the OG aspect of it and then where it's permeated from there, because I think the iteration of what you're doing now in venture capital is pretty fascinating, and it's based upon the experiences you had in the past.
Sure.
So welcome.
Sure. Well, thank you, Bruce. Thanks for having me. Quick background on me. I met Peter Thiel when I was 24, and I ended up meeting Elon, I think, when I was 25. So if you meet a luckier person than me, then, tell me about it, because it's
Pretty cool stuff.
I've had a very blessed path. So I met Peter very early in my path. He convinced me to come out to Palo Alto and help him start this business that eventually evolved into PayPal. So I think I was employee number 11, technically, and then ended up running the corporate international operations. And then when we sold the business to eBay in 2002, he and I left together and took our newfound bit of wealth. Peter's much more than mine. And we started a global macro hedge fund that used to be called Clarium. Now it's called Thiel Macro. And then do a lot of other things as well on the private tech investing side.
And there's been a huge evolution, and we'll get to that later. And it seems like it's almost the final countdown to AI, and you definitely have some opinions there. But as you've kind of evolved through this process, you've seen a lot of technology kind of come and go. You've seen a lot of boom and bust, so on and so forth. And it eventually, where our paths crossed, candidly, was through Arizona. And you had a vision for Arizona and what you thought. Now, that vision is slightly changing as the fund is evolving, but kind of, I know it captivated me because pre-COVID and post-COVID, there was a material change from, information and intellectual capital just being in the California, Silicon Valley area and moving out, and you had a thesis behind it. Share with the audience kind of what that thesis was, where, how you came up with the fund idea in Arizona. Maybe give a few examples, things like that, just for consumption's sake.
Sure. So I moved to Arizona as an adult when we sold PayPal to eBay again back in 2002. So I've been in the greater Phoenix area for 23 years now. And so I've been observing the tech ecosystem in Arizona for a while. And during that period of observation, I noticed a couple different things. So on the good side, it's a population hub. It's the fifth largest city in the United States. There's some great universities in the state, great entrepreneurial talent. But the one ingredient that seemed to be really missing locally in Arizona was the financial capital component. And so what I mean by that is that if you were a young entrepreneur that came out of ASU and you had a business idea, you could probably find someone locally who would write you a seed or angel level check. So let's say, for discussion purposes, say $500,000 check that would allow you to prove product market fit, get to post revenue, all the kind of standard first steps, if you will, as an entrepreneur. But what would break down is that if you went out then for a proper Series A check, so just to define terms, so let's say a $3 to $5 million check to could really accelerate your growth from here to here, that was very difficult to find locally. And so what happened is that a lot of our best and brightest entrepreneurs that had product market fit and were off to the races, so to speak, they had to get on a plane and they had to go fly to Denver or Salt Lake City or, God forbid, the Bay Area and Sand Hill Road and try to raise money. And it's very hard to raise money, especially when you're coming from out of town, because most venture capitalists are creatures of habit and they like to ride their bikes or at most drive their cars to their board meetings. And they certainly don't want to have to get on a plane and fly an hour or an hour and a half.
Think of all that intellectual capital that's just left off the sidelines.
It is. And in the Silicon Valley's defense, since I spent a fair amount of time there, there's a tremendous amount of intellectual horsepower and talent in a very concentrated area. So it's arguably the most dense home per capita of talent in the world. So in defense of my Silicon Valley venture capitalist friends, they don't really need to leave. And so
Yeah, because the ecosystem's coming to them.
there's just so much talent in the backyard. Stanford's never going to move. Berkeley's never going to move. And it's been this melting pot for the world's best and brightest from a technology perspective for decades now. literally. So coming back to the Arizona context, our entrepreneurs had to get on a plane, they had to fly, raise money from out of state, and a variety of different kind of negative feedback loops started. So one, a lot of the folks just couldn't raise money. So they died on the vine, went out of business. So that's obviously bad. The second scenario is that if you got money from one of these out-of-state venture capitalists, often there was almost like a gravitational pull to spend more time in the state from where the check was written. And then as an addition to that gravitational pull, often the companies had to move an office or the entire company to that out-of-state geography. So that's obviously bad. And then the third issue, which is arguably the worst of the three kind of negative feedback loops, is that if you have a good financial outcome, that windfall, so to speak, then gets realized and recycled into that state from where the check was originally written. So even though in Arizona we may be giving birth to these great companies with these great entrepreneurs, if the Series A and beyond checks are being written by out-of-state financiers, they are the ones that really benefit financially. And then they take that windfall and put it back into their out-of-state ecosystem. And we don't see any of the financial benefit in Arizona. So that's obviously bad. So having observed that for a while, I started a nonprofit with a couple of friends over a decade ago with the idea of helping to elevate the local tech ecosystem. And as an outgrowth of that nonprofit, we started a for-profit Series A traditional venture capital fund. That was a vintage 2022, I should say, fund. And so that's what we do. We look to fill that gap that's existed for a long time so that our local best and brightest entrepreneurs can get that Series A check locally. And then hopefully when they're very, very successful, we can take that windfall and push all those chips back into the table and really get that snowball going.
Did it take time in Arizona to get that message out because of the fact that it wasn't part of the ecosystem, or was the demand, I mean, was a request for capital very high? I mean, did you have a lot of people coming at you?
Well,
Did it take some time to even educate the space is my point.
so there was always kind of a local debate where the entrepreneurs would complain that there just wasn't enough risk capital locally to satiate the amount of entrepreneurial.
This was primarily real estate, right? I mean, is that kind of what
Right.
it is?
And so that's on the entrepreneur side, they would complain that there wasn't enough financial capital that was willing to take a risk on these early stage companies, which by the way, in their defense, or I should say non-defense, are very speculative. And then most of the affluence in Arizona comes from the real estate sector. And real estate's a fantastic asset class, but it often has a mentality that is almost fixed income related. So they use terms and phrases like coupons and cap rates and so on and so forth. And it's very different from what early stage entrepreneurs do. So I would equate it to like what a wildcatter would do in West Texas, in the sense that you're sticking a straw in the ground and you may have a dry hole and you might have a gusher. You just don't know, versus there's absolutely no fixed income coupon component to that type of approach. So what happened historically is that the folks that had the money locally, the affluent sect, so to speak, they just couldn't relate very well to the entrepreneurs. And so that was a real source of friction.
Yeah. I think, since COVID, really, I've noticed the amount of problems that occur and that dissipate, the acceleration of those issues really kind of come and go very quickly. You spoke a little bit about how you started the fund in 22, right? But we're also in 2022, we're coming off maybe the biggest liquidity push since COVID, which drove valuations through the roof. I mean,
Right.
It's kind of funny. We've been friends for a few years now, and we're almost going through two big mega cycles in technology. The first one, in my opinion, was the crash in 2022, and maybe the pending, looming concerns of where AI is today. And normally those super cycles would take 10, 15 years. And now I feel like a swan tail's coming like every 2.5 years. But in 2022, how was that environment to raise money? And then once you raise the money, how did that affect valuations for the fund?
So the honest answer is we got really lucky. And so what I mean by that is that if we, let's say hypothetically, if we had closed on the fund a year earlier,
Which was the plan, kind of, wasn't it? I mean,
well, we got started and it took us about 18 months to put the fund together.
to educate.
So yeah, no, because we raised the fund almost entirely from Arizona folks, because the idea was, okay, let's get as many of our local friends on board so they can add value in addition to just writing a check. So they can be sources of deal flow, they could be mentors, all these different value add components. And so, it was a process, as all these things are, but we got there. and that's the good news. But to come back to your question, if we had closed on the fund more quickly, and we closed on it, say, in the summer of 2021, we probably would have felt compelled to start deploying capital relatively quickly. And if we had done that, we would have been plowing money into what the 2021 vintage is probably the worst vintage of all time.
Correct.
Maybe with the exception of the current vintage today, but we'll
Right.
save that for a moment.
Right.
But 2021 was a horrific time to be investing in technology, especially late stage, which is not what we do. But in any event, if we'd been investing in 2021, it would have been literally game over already, because we would have been investing in the top of the cycle. Our entry points would have been very, very overvalued. It would have been very difficult for us to recover. So that's one. On the other hand, in terms of how we were so lucky from our timing perspective, is that if we had waited even slightly longer to close on the fund when the markets had really turned down, we would have never gotten to the number that we got to.
You would have never raised the money.
Well, we may have gotten, to some number, but we certainly would not have gotten to our goal number. And we actually exceeded our goal number by $15 million.
Correct.
For a first-time fund in a non-coastal state, it's, not to pat myself on the back, but that's a pretty significant enough.
Jack, and when you think about it too, when you're thinking about the hype of real estate in 2020 and 2021, people are like, why should I invest in technology when I'm making so much money over here in real estate? So that wall of opposition of skepticism was very real. You know what I mean?
Sure.
I don't think anyone who's an investor today is having any of those kind of issues because of the prices that you bought it at, right? The portfolio, how invested are you in the portfolio now? How deep on the $115 million fund, how many shovels do you have in?
Yeah, so we have just over 25 companies total, and we've deployed roughly just under 50% of the capital. We have a holdback ratio of 1-to-1. So what that means in kind of plain English talk is that for every dollar that we invest, we hold back $1, so that hopefully we can double down on that company when it's having future success. And some companies won't work out, some do, and so that overall ratio will probably be closer to 60-40. But really the way venture capital works is that, you make your initial investments, and then after you've made those initial investments, you try to figure out which are your best and brightest, and then you try to double down as much as possible on those companies.
And that's how you think you make money in this. I mean, it's been a tried and true portfolio strategy.
This is kind of the venture capital 101 type playbook. And so we're just following kind of these basic tenets, if you will. And so we've mostly then, given this 1-to-1 reserve ratio format, we've mostly deployed this first fund. So we'll be going back to market here relatively soon for our second fund. And that fund will be essentially kind of the same thesis, although it will be a little bit different in the sense that the geographic footprint will expand, because I feel like we've proven out the thesis with fund one, and we want to take that thesis that I think we've, again, proven correctly in Arizona and take it more broadly to the other non-coastal states.
And I'll get back to another question, you obviously have a viewmaster on where those new areas of incubators could be. Where are some areas, without giving away too much of the secret sauce, that are you focused in on that you think are a great embryonic place for you to invest? Where are you seeing that intellectual capital? Is it like in Austin, Texas? Is it you mentioned Miami was not really a high interest of yours. Where are some of the areas?
So I'll come back to the geographic question in a second, but maybe I'll flesh out a little bit in terms of what I meant by the thesis in the last answer. So I can break it down in pretty simple terms in the sense that it's a non-coastal geographic arbitrage.
Okay.
So what does that mean in the most plain of English? So what it means is that if you get outside of the 3 states, so Massachusetts, New York, California, those 3 states last year took down 75% of all venture capital investment. That was an all-time high. The previous high was in 2021, to your question earlier, which again was only 4 years ago. That percentage was 61%. So to give you a sense of how much higher this concentration level last year was. And in 2025, obviously the year isn't over, but I would bet you a cup of coffee that that number this year will be north of 80, and it could even be north of 90%, meaning that 90% of every single dollar of venture capital spend in the United States goes to Massachusetts, California, New York, 3 states. How many people as a percentage of the United States population live in those 3 states? Less than 20%.
Yeah.
So at the core of it, it begs the question, these other 47 states, Arizona included, represent 80+% of our population.
Right.
So at its true core, do you think there are any smart, capable entrepreneurs that live in these other 47 states?
Facts, yes.
Right. So, because that's what, 270 million plus people.
Right.
So, but this geographic area is massively, massively, massively undercapitalized, especially because venture capital is getting over and over and overly concentrated in these three states. Why? Probably undoubtedly to some large extent because of the AI bubble, which certainly we can talk about.
Yeah.
So the thesis is this, is that you can invest in a non-coastal company, say in Phoenix or Topeka or Montgomery, Alabama,
Wherever.
and the company will have the same metrics in terms of revenue, margins, growth as that same company that's in Palo Alto or Cambridge, Mass, or the West Side Village in New York. And the discount, the entry-level discount for that Series A valuation is a discount of 70%. So the entry level is amazing. So you enter at a great price, you coach the companies up, and then you go take the companies to all the people that I know, which is the edge, so to speak, that I know from my
Yeah, I was going to say that's an interesting arbitrage.
That's it.
And speak to that. I mean, so you're buying these valuations, but I think from a strategic perspective, these entrepreneurs, everybody's saying, wait a minute, not to bloat the ego or anything like that. I know you're a very humble person, but the concept of saying, hey, you have a network of people in these coastal areas that can be of high value to you if you can do proof of concept, and therefore your valuations change, the amount of tension the amount of tension you're going to get, and you don't have to fight and struggle your way up that stream because we already have those paths really well drawn down, especially also with your contacts in the Middle East and so on and so forth.
Yeah, that's exactly the case. So when you sit down with a young entrepreneur and say, okay, I can write you the Series A check for your young company here in Topeka, again, anywhere else non-coastal.
Right.
And again, you coach them up. And then if you aspire one day to go talk to Sequoia, you call up Roll-Off. Or if you want to go talk to Greylock, you call up Reed. Or if you want to go talk to Founders Fund.
And you know all these people.
We worked with all these people back in the day. So this is not kind of a hypothetical degree of connectivity. These are people, that we were in the war with back in the day. And so we know them very, very well.
And what kind of blows my mind too about venture capital is that's institutional venture capital. I mean, the new world of private businesses now that have become unicorns that don't necessarily have to pull on the capital markets. Part of it, and if you would like to speak to it, is troubling. I think the S&P 500 since 1998 has 50% less public companies. Liquidity is like less, liquidity's been cut in half. I feel like we're a country of buyback programs and preserving cash. So I think that there is a slot for venture capital. And then from your level of venture capital, which is kind of the Series A, as you move up that vertebra, that becomes almost becomes like a semi-public market, so to speak. So knowing those players become a critical component. The opposite side of that, for you to speak at it, we've seen some unicorns that have become super unicorns, companies worth $50 to $100 billion. How do they even get liquidity? I mean, are they going to be able to go public? I know that's just kind of a side question I've had because it's been a question that's been bugging me for a little while as some of these mega private businesses are trying to figure out ways to get liquidity. We recently saw that with ChatGPT trying to get some liquidity for some of the insiders, and they raised $6 billion for that matter. I think Stripe, a few years back was trying to figure out ways to settle some things with the IRS bills and get some liquidity. Does that concern you at all?
Well, I mean, it does and it doesn't, in the sense that as these companies continue to stay private longer, which is a natural outgrowth of the macro environment. So after the financial crisis, interest rates were basically zero for 13 plus years. So we were awash in easy free capital. And there were all these different asset bubbles that got started. And I would argue that the tech asset bubble of all these different bubbles was the largest by far. Why? Because most people associated, I think probably somewhat rightly, that tech equals growth equals yield. And so when yields are zero, you go even more into tech because you think you'll achieve that yield that otherwise doesn't exist. So the tech bubble became very large. And so as these companies stay private longer and longer and longer, there's no shortage of people running around in the secondary market trying to fill that gap for employees that need to have some liquidity, that want to go buy a house or put their kids in college or whatever it may be. So I think on the one hand, that's fine. But the structure, going back to the bubble topic, and again, I'm probably more befuddled by this dynamic than you are, is that 2021 was only 4 years ago. We know what we were doing 4 years ago. And usually between cycle tops, it's a decade plus. And you can feign ignorance because you were too young or you don't remember or whatever the case may be. We all know what we were doing 4 years ago. So what's my point? My point is that at the top of the market in 2021, you had all of these secondary brokers running around that were basically creating false markets. So what do I mean by that? Is that they would go out and say, hey, listen, I've got a slug of SpaceX. And even though they didn't have it, they would go out and pretend like they do and get all these different buyers and essentially bring as many of these people together as possible. And then once they gathered them together, say for a $50 million slug, then they would go call up the CFO at SpaceX and say, hey, listen, I've got all these buyers, let's go. And so this was going on endlessly. But the real issue there was not so much the matchmaking, was the fact that these SPVs were totally opaque, fees on fees on fees.
The fees are crazy.
Fees are crazy, and then massively illiquid. And this just happened 4 years ago at the top of the market where people lost their shirts.
It got smoked.
And here we are in November of 2025.
It blows my mind.
And people are running around by selling access, or I should really use the verb peddling access, to all these rocket ship type AI companies that are just astronomical values. And the fact that there are still buyers who are, a lot of these people are very, very sophisticated, that are looking to get into these companies because, you need to have something to talk about at your next Manhattan cocktail party. But the idea that you're going into these vehicles that, again, that are fees on fees on fees, totally opaque, and you're locked up for at least a decade plus.
Least.
It boggles my mind.
So how do they get out?
They don't. I mean, imagine, as a very basic thought experiment, for all the people, not to pick on one company, but if you had the ability to sell out of your SPV that invested in OpenAI at $500 billion,
They're done.
what percentage of those private holders would sell?
I have to believe it's a lot.
90%? 95%?
Whatever. It's a lot.
100%?
Yeah.
So point being is that it's like Hotel California, Roach Motel. You can go in, but you can't leave.
Yeah, but Jack, they're even talking about taking the company public next year.
They're not. That's complete nonsense.
I don't see how they do it.
It's part of storytelling. And so there's a high correlation usually between storytelling that is literally knowing no bounds and your ability to raise money. And so, or your need to raise money, I should say. And because unlike almost any other technology revolution, however you want to put it, this one is so CapEx intensive.
It doesn't matter.
Basically one-for-one inputs for the outputs. And it's just really expensive. And so when you run out of money of raising money here privately, then you go internationally. We won't say where, but you go all over the place internationally. And you run out, and when you tap that out, what do? Your last holdout is to talk about going public. And that pool, I think, is much more shallow. There are only so many meme investors that are retail that'll be on the public side that would be buying these types of companies if they were to go public.
Yeah.
Do you think Fidelity and T. Rowe and that equivalent are buying these companies at these types of multiples?
No.
Not at all. Zero.
Yeah.
0%.
Yeah.
So they run out of capital.
Well, because we've been now hearing rumors of maybe even the government backstopping some of
Well, this is another great example is that
Talk to me about that a little bit. You might have some insight.
If the CFO of the most prominent artificial intelligence company
He's talking about the
is
government.
going out in a very, very public interview and floating the balloon, which ends up being a lead balloon as a trial balloon originally, talking about how maybe there should be government backstops. And then our crypto czar, David Sachs, who's a very good friend and I've worked with, and he quickly shot that down.
Right. As soon as that announcement was made, bid side of the NASDAQ just went south.
As it should.
And oh, by the way, if you remember this last earnings report on Meta, the infrastructure spend actually got the analysts' attention for the first time. They're like, wow, this is a lot of money. You guys are going in. And then the credit default swaps, I'm not being negative. I'm just
This is true.
merely talking math. Credit default swaps for Oracle's debt, went through the roof.
Oracle's debt ratio was what, above 400%?
Right, it's
And
big
so-
now. And so that's a big bet.
It's one thing if OpenAI does not realize its ambitious goals. If that was just the case, if it was perfectly insulated, if OpenAI didn't meet its private numbers, its venture capitalists would be disappointed. And by indirect reasoning, the LPs would be disappointed. But that's obviously not the case because OpenAI is the centerpiece for this entire ecosystem that essentially is very, very, very intertwined around it. And so—
And you're talking about these kind of circular contracts.
all of the above,
Right.
all of the above. And so another, talking point that I would offer here that I don't think gets anywhere near as much attention. So OpenAI has a relatively new CFO, She came on board earlier this year. And so what she did within the first month, I think, of being on the job is she had to revise her financial expectations in her new job. And so what did she do? So she said, okay, well, our previous estimate of what we are going to burn in terms of cash between Q2 of 2025 and 2030, originally, the prior CFO thought that was going to be $30 billion. And so she comes in, new person on the job, new sheriff on the town. This is the positive glass half full interpretation. Is like, oh, well, those numbers are wrong. We have all this breathless growth, by the way. And just as a side note, that burn number is going to be 110 billion.
Yeah.
So that's 300 some odd percent higher than what it was before. And only barely did kind of the Silicon Valley press pick up on this. You got very, very little play in the New York financial press. But imagine, just as another basic thought experiment, if she had been a CFO of a publicly traded
No way. Doesn't even fly.
she would have been fired the next day.
Right.
And
Doesn't
the
even,
company would have sold off by how much?
right. A bazillion.
And then because this company is the centerpiece to this entire ecosystem that now involves huge amounts of debts, what happens if you're the banker that lent all that money to Oracle? Does that trip some covenants?
Yeah.
Do you go in and take the keys, whatever that means in the case of Oracle? And then what happens? And that's when the contagion starts and it just goes.
Yeah. What you're describing to me is the way all financial crises begin. It's usually dealing with some form of liquidity issue.
Well, liquidity and debt.
Right.
And so
Credit.
leverage.
Right.
And so when you bring leverage, so if you look at all the different financial crises through modern economic history, the one common denominator is leverage.
And we got a lot of it.
Well, we have a lot of, and it's a weird pairing here because you have a kind of a real estate bubble that's going on, you have a technology bubble that's going on, and now you have a financial bubble that's going on. So it's like a mother of all bubbles with all three coming together.
You know, I saw a chart the other day that talked about the valuation of the internet bubble versus revenue growth. And so you would see this bubble, you would see the height of internet stocks, and then you see revenue doing this. And so it was very, in hindsight, very easy to define, well, that's a bubble.
Sure.
The difference is, history doesn't repeat, it rhymes. Today, now I'm seeing valuations go like this, but I'm also seeing EBITDA growth also grow alarming. I think that's what's catching people off. You've got real systems. I'm just giving you a counter argument to that. And then you have individuals, by the way, I'm not picking on any institution, like JP Morgan just came out every day and said, we're not in a bubble. And I'm like, wow, that's pretty bold. I mean,
well, everyone's stuck in their own book, right? At the end of the day.
No, I understand that.
So people have this concept of, oh, it's a good bubble. Have you heard this?
It's a good bubble.
It's a good bubble because it's going to create all these companies
opportunities.
Even though there'll be some drawdowns and some will fail, the technology advancement that it will make for society will make it a quote unquote good bubble. My kind of cynical half take on that, it's a good bubble if you're long the underlying asset.
Though, Jack, I've seen bubbles, and I'm old enough to say you have too as well. When the real estate bubble, which I think was actually 5 years ago, you know what I mean? You're starting to see remnants of it, but there was so much money in the system. You had family offices, you have pension funds, you have these global private equity funds that have poured billions of dollars. They almost self-sustain a comatose zombie type environment. I think you're starting to finally see the cracks of the defaults in the real estate real estate arena. And we're talking now 6 or 7 years later, when I thought the bubble was, 6, 7 years ago. The fumes of this, I was just in Riyadh, so were you. Okay. I was astounded by the fact that, a lot of the discussion was, oh, we're a $600 billion company that grew to $1.5 trillion, and all they talked about was AI. So if this bubble is to crack, this is a global bubble. This isn't just to the United States. You're talking about China spending a lot of money. I guess the question I'm trying to drive to, which I would love to hear your opinion on, should it be a bubble, or is this more of an arms race? Because I just feel like everybody has to. I mean, what are the consequences if a country or an institution loses the AI bubble? I mean, would you suggest, if you were an advisor to an AI team, hey, pull back, don't do AI, or spend the money and do it? That's the conundrum that's being faced, because the consequences of not being involved in AI. I guess the simple question, how important is AI to our future? And is it? I mean, let's peel back the onion a little bit and say, AI has been around since what, 1954? It's not like a brand new concept. I mean, I think it was Dartmouth that invented it. I mean, Watson and IBM have been involved in AI for quite some time. Why all of a sudden now? I mean,
well, the reason why, so I think it was in Q2, supposedly half of the GDP growth that we experience here in the United States was related to AI infrastructure build. Half.
It's
Half.
huge, man. It's so huge.
So-
it's like the housing industry before the collapse in 08.
Well, this is where I was going with the answer, is that, because again, it's not just a technology exuberance. It's now a financial exuberance and it's real estate exuberance, all wrapped up into one. So what happens if the music stops? It's not just a problem in Palo Alto or New York or Main Street with the real estate component. It's a big problem. And so, yeah, I mean, again, if we were sitting here in 6 months' time, I mean, I would bet you a cup of coffee that there is some sort of adjustment down. Now, I don't know what that trajectory looks like, but it is so over the skis. It's by far the biggest bubble I've ever seen in my lifetime, going back to, pre-dot-com crash times at PayPal. So, and, talk about this a fair amount. So I think most people, I think it's a consensus point of view at this point. So it's kind of boring to talk about in the sense that, okay, everyone agrees, fine. But the more interesting bit is, okay, well, what are they going to be the catalyst that bring this to some sort of end game? And that's where it gets interesting. And so there's all sorts of different, and we probably don't have time here today, but one of the aspects that I like to focus on a little bit, and it's not that helpful from a specific timing perspective, but the amount of litigation finance that I have personally seen that's come across my desk and I see kind of within my family office world and travels is quite significant. And these aren't just your typical ambulance chasing type attorneys. These are Stanford professor types, Harvard professor types that are basically signing up with people that own world-class content that they feel like has been pirated or stolen from them, that is being used for either direct or shadow training purposes by these big AI companies. And so for the uninitiated, there was a big lawsuit that Anthropic settled earlier this year to the tune of about $1.5 billion. I'm not an attorney, but having done a fair amount of research on it, the judgment was pretty evenly handled between both plaintiff and defendant, but blood is in the water. And people realize, because that settlement basically worked with, or it dealt with authors had written books. And so the average payout was like $500 a book or something equivalent to that. So relatively small potatoes compared to what's going on now behind the scenes. So what I just offer you there is pretty useless from a specific timing catalyst perspective. But if I'm seeing, say, 10 or 20 pretty world-class litigation finance deals from my perch, I'm seeing 5% of the market, 10% of the market, maybe not even that much.
Dude.
So if there's another 80 or 90% behind that as a wall of worry, that wall of worry only needs a few cracks. Like, imagine if we wake up tomorrow, we pick up the paper on the front of the Wall Street Journal, and Anthropic had to settle a $5 billion lawsuit or a $10 billion lawsuit.
So you just blew my mind, because when you think about contingent liability, I've seen that relatively untouched in the AI world. And now you just opened up my mind. This could be gigantic.
Well, it's uninsurable.
Yeah.
So they have to self-insure. And so imagine,
Whoa.
So if Anthropic had to pay a legal bill, or legal settlement, I should say, of $5 billion, or any of these guys, or even these smaller folks, if they get drawn into this, and again, this is just one of many, many, many catalysts I could talk about, and we don't have the time. But most people aren't attorneys. I'm not. I've just done some research on it. But if any of these cracks start showing up in this wall of worry as it relates to litigation finance around AI, look out below.
Whoa, man, that just blew my mind. What's the upside of AI? Is the benefit even there? I mean, what do you, forget the valuation aspect of it now?
Yeah, I think I always worry on this topic that I'm coming across as a Luddite. I didn't take a horse and buggy to get to Las Vegas today. I flew on an airplane. I believe in technology. AI is real. And, we've talked about, if you think about all the breathless technologies that have come forward in the last 30 years, almost all of them take slower to get realized than the original storytelling likes to demonstrate. And so I think AI is probably in that same camp. Like, people were telling us that we were going to have driverless cars, and here it is, 2025. I mean, Waymo works in 4 or 5 cities? Right. That's great. It's better than zero.
I saw Waymo goes on the wrong one-way street the other day. Yeah. Kind of freaky.
Yeah, like AR, VR, if you remember that. Yeah. I mean, the list goes on.
How about metaverse?
The metaverse, is literally a grocery list of stories that we were told. We were told those stories. Why? To raise money. But AI is different because it's so capital intensive. It is by far the most capital intensive technology innovation out of all those items on that grocery list. Again, it doesn't mean it's not real. And you can use ChatGPT and it can save you some work here and there. But coming back to the venture capital perspective, I think 2 things here on this topic. One, I think AI has become a ubiquitous ingredient, a pervasive and ubiquitous ingredient that almost every startup company, not just in the coast, but throughout the entire world, you see that ingredient in almost every single recipe, or a recipe being a startup company. And the fact that that's happened so quickly, that's actually quite impressive. And the number I'll give you, that the force multiplier that AI is able to achieve, just to give it some real numbers, it's probably on the order of 10. So what do I mean by that? That means it makes companies achieve, all things being equal, 10x more revenue. And also is able to do that with 10x less overhead. That's a real number.
That's huge.
But how many zeros are there in $500 billion? I don't know, a lot.
A lot.
A lot more than one, which is what 10 represents. So that's that. So that's the good news. But the less good news is that because it's so incredibly overvalued and the music's going to stop, and when it does, it's not going to just be a problem for Palo Alto or for the bankers in New York or for Main Street as the real estate investors. It's going to trickle down to all of us. And so, but if you invest in good companies, and this is my last point on this, is that if you're trying to invest in pure play AI privately, like if you're trying to find the next OpenAI or Anthropic, I literally think the asset class is uninvestable. If you want to have AI exposure, go buy Google, go buy Meta, go buy Microsoft. It's a dull, blunt instrument. But good news, those other businesses that those companies do outside of AI are real businesses.
And I heard actually Peter speak at your conference in Wyoming saying eventually they're going to catch up. You know, maybe not right now, but to the ChatGPT level. I mean, it takes some time, some inefficiencies, but he also was an advocate for that kind of discussion.
Sure, and if you can get in early to if you had gotten early, I should say, to these pure play AI companies, like I think Peter was the first check to Sam when he was starting OpenAI. So for Peter, whether it's worth $500 billion or 20, it doesn't make any difference. It's still an astronomical, world-class GOAT type return.
Right.
But if you're trying to come in today,
forget it.
And you're some family office in New York and some broker comes in and says, hey, I've got this amazing SPV. What do you think? It's uninvestable. Why would you ever do that versus just go buy Microsoft? If you want to have AI exposure and you have this massive fear of missing out, just go buy a publicly traded company. And you can punch out of that company in seconds. In seconds with no fees and perfect information rates and so forth.
That brings up an interesting question. You see recent news of an icon, Warren Buffett. You know, if you read his letter, it was kind of emotional. I think he's an American hero in some ways, in the way not only just to look at investments, but in life. He puts in his retirement, he goes away. Next big position is Google. Didn't that kind of catch you off guard a little bit? Like, where have you been, man? Well, do you have any thoughts on that? I mean, that to me blew my mind. I don't want investment advice, but did that move kind of catch you off guard a little bit? It caught me off guard. I can tell you that.
Well, I agree. I think I made my first and only pilgrimage to Omaha for the annual event last year, and my only regret was I didn't do it earlier. It was really and it was the first annual meeting after Charlie had passed, and so there are all these different memorials, and it was just it was an incredible time. So one bit of advice for all of your listeners is that you have to go out to Omaha to see the show, because it's truly it's a bucket list type experience. And in terms of Warren buying Google, I don't have a strong point of view because I'm a private tech guy, but he's the best of all time.
He's the best of all time. Jack, so now you've talked about AI from a systemic perspective and some of the things that are concerning you. How does that affect you now, being in a fund and maybe raising another fund, and how it affects your judgment in looking at new businesses? I mean, because if you have that, thing in the back of your mind, whatever happens, if that bubble bursts, affects at the fund level too. How do you consolidate those two thoughts, and how do you make those decisions? Those are tough decisions to make in this environment. 22 was maybe easier because the valuations dropped and you bought right in. New fund is going to have this backdrop. Are you staying a little bit more away from the AI space and getting more in traditional technology, or how are you thinking about that moving forward?
No, I mean, again,
it's complex. It's more complex.
It's the simplest way I could describe it is that our portfolio companies, generally speaking, in a non-coastal environment, these are not pure play AI companies. Like the next OpenAI is not coming out of Phoenix,
right,
or Des Moines, or again Montgomery, Alabama.
So I'm saying, what kind of technologies?
So these are companies I would, I don't want to say ordinary because that, presumably has a pejorative term, but these are companies that are proper companies. They're good companies that create real value. And then they use the secret sauce of AI, again, on an order of 10 to make them 10 much more revenue at 10x less costs.
Yeah.
So that's fantastic. And I'm a big believer that, it's jockeying out the horse. In other words, you're investing in entrepreneurs.
That's what I was
no one has
Right.
no one has a crystal ball that says I want to be at the beginning of each year or whatever time frame you like, that I need to be in sectors A, B, or C. No one has that. And that doesn't mean you can't have a macro perspective that I think this sector is going to be better than that sector on a relative basis, but I just don't think that works. And so what I do think works is that if you could find rockstar entrepreneurs that want to work on something for the rest of their lives and create a tremendous amount of value and want to run through brick walls, that's the starting point. And then if you can understand what they actually do as a secondary point of the conversation, then you may have an investment on your hands. But that's the approach.
If you're a young kid getting out of college, you want to start a career, okay? There's a lot of anxiety about what AI is doing to some of these kids and their job prospects. If you were to tell a kid going from high school to college, best advice, what to learn in college, what would that advice be?
So I'm biased. I'm a liberal arts major, and the pendulum has been swinging back and forth on this type of topic for a while. And so, a decade ago, everyone thought that liberal arts were completely outmoded and they were headed for the dust heap. And now I think it's coming back the other direction. So to give you a little bit of more granularity on what I mean specifically is that a skill as basic as communication is so exceptionally important. And this will always be the case, especially in a context of AI. So AI is never going to be able to summarize the 15 paragraph email that your boss sent you or your underling sent you. You have to read that yourself, and you have to be able to communicate that. And if you can communicate succinctly and clearly, that's a real skill. And I worry that our young friends that are becoming arguably too dependent on AI are missing that point. Because if you let ChatGPT try to summarize a 15 paragraph email, you're going to miss a lot of things, and you're going to end up having to do
The nuances.
You're going to end up doing more work than if you just did it yourself, as opposed to relying on ChatGPT. So I worry that this younger generation, while ChatGPT and the equivalent have a lot of different, the positive aspects, you can't become over-reliant. And communication, I think, is one of the better examples of this, because if I could find a young person that can take that 15 paragraph email and summarize it perfectly into one paragraph, as basic as that sounds, that's a real skill.
Jack, I'm going to have you back because I want to talk to you on the next show someday about, the politics of AI. There's so many different things, the race to AI, venture capital, the debt crisis, it's all coming. At least we're living in interesting times, but,
Yes, we are.
But unfortunately the fireworks may be in our backyard, and we're going to have to hear some explosions before anything else occurs. But I know you're traveling across seas. I can't thank you enough for being on this small program and, kind of giving our audience some thoughts. And I always learn a lot from you. And so, just the valued friendship and everything, I'm just very appreciative of you spending some time with us today.
Thanks for having me, Bruce.
All right. Thanks, brother. Goodbye.